Why is the cost of equity dangerously misleading for a high growth startup?
The faster you grow, the more expensive your equity is. If you are in a relatively stable stage where your product is predictably generating ROAS for you, raising a whole bunch of VC capital and equity is an incredibly expensive way to meet your goal, which is to make as much money as possible.
Today I'm joined by a former VC and gaming exec who led international growth at Mobile Premier League, helping the company scale to 90 million users and expand into Europe.
Gaming and consumer apps businesses are just remarkably capital intensive, and they spend that capital on marketing. That means that vast majority of companies are in fact spending more than 50% of their revenues on marketing. That's the realization that people don't have.
In this episode, we talk about why equity is often the most expensive way to scale, how Cohort-based UA financing works, and what profitable studios need to know before doubling down on growth.
It's very likely that if you are getting 130% ROAS, you're spending in excess of 75% of your revenues only on marketing. All of your other costs are in that 25% bucket if you're trying to be profitable.
From someone who backs marketing spend with real data and millions of dollars, this episode's guest, Ridzki Syahputera. Ridzki, welcome to the show.
Hey, Ari, thanks for having me.
Thanks for coming. We met in Gamescom nearly a year ago, and then we kind of met again at GDCY, my hometown in Cyprus, 2 weeks ago. And yeah, I remember you mentioning the things you were doing. I just found it like really one-of-one type stuff. Like you have big bag of money and you're kind of breaking the norm, so to speak. So yeah, how's it been for the last 12 months?
Oh, it's been a really rewarding journey. I'm super grateful that I get to work with a lot of the people that I've been working with for the past like 5+ years in multiple companies prior to that. And you know, this is the first job where I've really been able to scope out the entire kind of gaming industry and even further beyond gaming into consumer apps, which I find really interesting. It's just such a cool ecosystem. I think back when I was working at a gaming startup, I was just executing, right? It's just me and the Meta ads and the Google ads and all the campaigns and my Excel spreadsheet. But this has really kind of like propelled me into the world where I get to hear about people's stories, which I think is one of the more fascinating things about the gaming industry. You can really come out of left field and you know, make the next big game. You can also have been working in the industry for 20 years and not find a hit, and then finally find some luck. So it's been a rewarding journey in that sense. And it still continues to be. Like I get to meet people like you who are also kind of in all of the events and getting to know folks better.
Beautiful. So today we got some juicy topics to go into. So we're going to get into, for people at home, financing alternatives to growth stage game studio. So breaking a few myths there. Also, studio models to watch. So we've got high scale markets, studio models to watch. And the third topic will be on modern UA and also data-led decision making. So you have your fingers in a few pies when it comes to like where to get the money from, but also how to spend that money to get users. So there's going to be a lot for people at home. Alrighty. I want to get straight into the meaty stuff. Why is the cost of equity dangerously misleading for a high growth startup?
Yeah, I think we can start with a little bit of context here. Because there's a misleading element to the cost of equity. But before that, we need to understand that it's particularly amplified by the industry that we're talking about. So gaming and consumer apps businesses are just remarkably capital intensive, and they spend that capital on marketing. Like, and I don't think enough people realize this, that so, for example, Gartner did a study in 2023 where they like surveyed a whole bunch of CMOs and across large public and large private companies. And they showed on average that the ratio of marketing spends to revenues, net revenues, was around 9.1%. Okay. So less than 10% of your revenues are being spent on marketing. Can you take a guess how much that would be for gaming and consumer apps?
Because I've spoken to a few of them, I'm going to guess quite high. I'm going to say 50%.
Okay. If it was 50%, it would be incredibly high, right? Like half of your half of your revenues are into marketing, and that's just way beyond the the average company's contribution to sales and marketing. So in our company, PVX Partners, we essentially looked at all of the ROAS metrics, the return on advertising spends of I think we evaluated 350 companies last year. So what we realize in measuring ROAS, which is basically revenues divided by cost or spends, is that in casual games, the 80th percentile of companies are reaching 200% ROAS in month 12, which means when they invest $1, they get $2 in revenue, right? In month 12. It tapers off after month 12 usually because the retention doesn't stay that long. In core games, it's 150% in month 12. But then over time, you add more incremental revenue because their retention is better. So let's just say it's around 200%, the terminal revenue that's being generated for every marketing dollar. That means that you're investing exactly that, 50% of your revenue into marketing. But that is the 80th percentile. That means that the vast majority of companies are in fact spending more than 50% of their marketing on 50% of their revenues on marketing. That's the realization that people don't have, that it's very likely that if you're getting 130% ROAS, you're spending in excess of 75% of your revenues only on marketing. All of your other costs are in that 25% bucket if you're trying to be profitable, right? So, and this is all to say that the industry is very different from the other industries in a way that you need to spend money to make money. That's the reality of the industry. And the truth is, I think that there are different stages of a startup or gaming and consumer app startup. There are apt capital instruments or sources of capital for each stage. But if you are in a relatively stable stage where your product is predictably generating ROAS for you, my argument is that raising a whole bunch of VC capital and equity is an incredibly expensive way to meet your goal, which is to make as much money as possible.
So why do people do that? Because I constantly speak to mobile gaming studios. They want to raise money and they're either looking for a publisher for the game or they want to, sell part of the game, even just like a revenue share model without equity. But I guess there's a few options, right? But I don't really hear anything other than,
equity and publishers.
Let's raise money.
Yeah. So the reason, and most of the companies that I think you and I are speaking to, the majority of them that I'm speaking to as well, are just not at that stage where their product is predictable enough to generate the marketing revenues across channels and in a scalable way. So the reality is that most companies aren't ready for it. So they need a capital instrument that is, for a pre-product market fit company, right? So they need capital that is willing to bet on the fact that they're going to get there. So VC capital is perfect for this. Basically, what you're getting for VC capital is you get a bunch of guys who are usually, ex-operators, investors as well, especially for the gaming VCs. They know what they're talking about. They know what to expect. And they're like, you have a good idea. So I'm going to put money towards you, and you're going to give me some of your shares, and I'm going to ride this journey with you. And that's the perfect type of capital, because if you don't get to a point where it becomes very predictable and you're profitable, then you don't owe them anything. Basically, you owe them whatever the value of your shares are, but the value of your shares, if you fail, they're pretty low, right? So it's a great instrument for getting to that, from that 0 to 1 stage. The publishers will come a little bit later. They'll want to see some KPIs. So the KPIs that they're looking for are retention metrics, some monetization metrics, ideally, and then even better so, some marketing campaign metrics, right? These three things are essentially early indicators of whether or not you will be profitable at scale. And they will have looked at so many companies. And their expertise is in saying like, okay, this benchmark is going to be good enough for you to make a lot of money if we funded it. Whereas at this benchmark, it's not. So they have that sense, and what they're willing to do is say, I'm going to fund all of that marketing for you, but you're going to have to give me a revenue share, usually for a really long time, like usually for like 5 years or something like that, right? And but they have an in-house team that can help you build, can help direct you, can help you with art, can help you with all of these things that you may need to help scale the business, right? To get that business in a competitive state with the rest of the market. And I think that's also useful for a lot of startups. But I'm seeing more and more startups and founders who are, who feel that they are able to get to that stage without the help of a publisher, not necessarily with the help of an investor either. Especially in where you're sitting in Cyprus, I'm seeing a lot of bootstrapped founders that are basically able to do this from 0 to 1. And now they just need to figure out from 1 to 1,000, where am I going to get the money? Because it's so capital intensive, right? So for these companies, that's the stage that I think this question becomes really relevant. If you're not at 0, you're at 1, and you have something that works, what is the capital you're going to take in order to take it to 1,000? So the alternatives that you have, or the options that you have, which is what you asked, is yes, you can take more VC capital. Yes, you can now partner with a publisher. Yes, if you're lucky and you're in the right country, you could take a bank loan. And the most common, especially with bootstrap founders, is I'm just going to invest. I'm going to wait until the money comes back, and then I'm going to reinvest that incrementally. So maybe we go through these 4 options, starting from the reverse. Or do you want to
I want to ask
Yeah.
the Cyprus example, because I've met these people, right? They've bootstrapped, they own 100% of the business, they go to the conferences, and I'm not saying they're chill, but it's like you said, make more money. Once we get it, we're trying to make more money, and cool. But then hearing what you said, like if they have a return on ad spend of like $2 and you put in $1, then it's literally a money printer, and you probably get economies of scale of some sort. Once you get more revenue in, you can probably do some cool stuff with that money that can maybe improve the return on ad spend, so to speak. So in reverse, like you said, like the model that you do, could you maybe just describe, like, because you mentioned before the call, you're doing these deals actively. So like maybe paint a picture for people who don't know about the offer that you have, and just like, using a loan essentially.
Yeah. So the model that we have is an instrument called user acquisition financing. So it's financing, like a loan, specifically for the use of marketing. And the way that the loan is structured is that we lend you a percentage of what you spend on marketing. Let's take a 50% example. So you spend $100,000 on marketing. You can request us to lend you $50,000, and we'll wire that to your bank account. What we'll do is then label all of the users that were acquired in that month that you were acquiring users. So let's say it was June 1st to June 30th. All of the new users that you acquired that month, we would tag as a shared pool. And then we would share 50% of the net revenues that are generated from that pool of users, until we, through the 50% revenue share, recoup our $50,000 investment. So we lent you $50,000, we're getting $50,000 back through a 50% revenue share. And depending how long that takes, we'll charge you an interest rate. What's special or unique about this instrument is that because it's cohort based, meaning we measure the cohorts, and we take a revenue share on the revenues based on that cohort performance. If you never get to recoup, you never get to 100% return on ad spend, you don't owe us that money. So we're taking risk alongside you. So this is why it's a useful product, especially if you're looking to scale and you don't know what's going to happen, when you double or triple or quadruple your spends. You want a partner that is able to finance you, but also take risk alongside you. And do that in a way that doesn't dilute you or require you to sell any of your shares. And it also doesn't require you to perpetually continue that revenue share, like maybe a publisher would. So you get to keep all of the upside, essentially, minus the interest rate. But that's essentially what we're offering.
Can I double click on this a bit? Because you are almost acting like a VC trying to decide, is this going to be worth in loaning to? Because if it doesn't succeed, it goes, let's say the return on ad spend is less than $1, you lose money. And we don't like those deals. And you only, in my opinion, from my understanding, you're taking deals that you know are going to win. And we spoke before the call, like you have a tool which gives you data, which I'm guessing helps you make those decisions as well. So I found it kind of funny. If I were coming to you for a loan and you rejected me, it's kind of like a free analysis, like, oh, wait, I should probably not be raising money right now. I should be doing something else maybe. So just something practical for the people at home. If I'm looking to raise money for my game and I got rejected by you, what is the main reason, like, I'm not ready to scale?
Yeah, so there's a lot of frequent reasons which we don't reject applications. We just basically tell them, look, you're not ready yet, but we'd like to keep monitoring you, and we try to prescribe the milestones that you need to reach in order for you to actually receive funding from us.
Awesome.
So from a practical sense, I think what you mentioned was true, that even if you don't get the money today, at least you'll have some guidance on what it would take or what you need to look like in order to receive financing. But the common reasons why we typically reject applications for now is that there's a high amount of volatility between month on month with your performance. So even if your latest performance or one of your cohorts in the last few months got to 200% ROAS, but the other cohorts around it are getting 130, 170, then 240 or 400%. Even if it's generally profitable, the inconsistency for us means that there's no statistical reliability in the future outcomes. And that becomes really important as I'm doubling down your spending over time. So I would much rather invest in a company that was getting 130% ROAS at month 12 consistently over 6 to 9 cohorts versus a company that was getting 200, 150, 180, 400, right? So the inconsistency part is a key factor in our type of loan, because you have to keep in mind that we don't get to participate in any of that upside, right? You get to keep that upside, but we take the risk if you fall below 100%. We take a lot of the risk if you fall below the 100%. So our business is being conservative in that way. The second most common reason is that there's a lot of there is insufficient payer retention in the long run. So I'll tell you what I mean by that. Some games, especially like hyper casual games or heavily IAA dependent games, they pay back very quickly. They'll get to 100% in like a month or 2 months. But then right after they get to 100%, all of their users churn, and then there's no more incremental ROAS after that. So a lot of people, they say, hey, I've got great payback periods. It's 1 month, it's 2 months. That's great. But what does it look like after 100%? Because if it completely churns off and you have 0 users, that means it's a binary decision for me it's a binary outcome for me where if I invest money, it's either you above 100% or below 100%. and there's nothing in between because you don't have the users to incrementally give you that margin of safety over time, if that makes sense.
Yeah. So the volatility. So let's say I have a mobile game, we do a bit of role play, and I have volatile metrics. And I'm like, Ridzki, we just had a whale log in. I'm sorry. It went really volatile that month. Like we can't control our volatility. Like why are games why did those games have volatile return on ad spend in your opinion?
That generally wouldn't happen for due to a whale, because typically we start investing when you're already spending greater than $150,000 a month on marketing, which means you're acquiring multiple whales, right? Like several whales in a month, and so one whale is not going to make a significant difference unless there's a huge Pareto law in your game like economics.
You got a Saudi
But
prince logging in or something.
yeah. Which if he's contributing like 200% ROAS for your entire cohort of 100,000 users alone, then what are like how am I supposed to rely on the second Saudi prince to join the next month, right?
And also you could probably isolate that right in the data, so that's also fine.
We can also isolate that in the data and see what's the contribution of revenue from what users. But the volatility point is very important and holds true generally in most cases when you're at scale. When you're at a minimum scale, you're not going to see like one user creating that volatility, or it's usually being caused by some breakdown in the funnel, some breakdown in the offers, or some breakdown in the marketing campaign, which if it's one cohort that does that, but then you have 5 other cohorts before and after that one cohort, generally operating the same way, that means you would have proven to us that you fixed it, right? So we wouldn't take that into consideration.
I want to ask you, what actually are you playing right now? Like, do you play games in your free time? What kind of games are you playing?
Yeah. So I grew up in Southeast Asia. I don't know. I think if you look at the demographics, there's a lot of concentration of MOBA players, like multiplayer online battle arena players there. So I grew up playing Dota, Defense of the Ancients, back when it was still a mod in Warcraft. Like I played Heroes of New Earth. I played Dota 2 when Valve came out with it. And then I eventually crossed over to mobile and then played Mobile Legends, which is from Moonton. That's the type of kind of format that will always kind of keep me coming back, because it's just once you spend all of your life learning how to play it, then it's like there's so much sunk cost there, and it's not easy to kind of like breach it if you're a new player, but it's really rewarding for like a recurring player to come back and play. Even if I don't play it for a year, I still have like I'm able to kind of keep up just by learning some of the new characters. But I'm also a big sucker for the Habby titles like Archero 2. Capybara Go was hilarious and fun. And then most recently I've been playing Whittle Defender, which is another their latest title, I think. But yeah, in my everyday like work day, I'm downloading games and trying them out. Like the latest one that I downloaded was from My Games, Castle. God, what is it called? It's called Castle Duels, which is pretty good. But I'm not hooked yet. Not quite there.
You playing for fun? Because it sounds like you're playing for fun, but are you also playing to kind of see what's out there? Because this is obviously very relevant to the thing that you do. Like one thing I tried when I play the Habby games, it's almost like I know I'm walked into a casino. Like the dopamine's everywhere, bro. It's just like and what I tend to do when I start enjoying a game too much, I delete it. So it's kind of I'm like the worst player from a data retention point of view to like track. It's like he uninstalled. Why? It's like it was too good.
Like for some games, you would probably see me as a user that's a whale. If you really hook me, I will spend like a small fortune on your game. That was the case with Mobile Legends. And then even on the console, I play, like I'm a basketball fan. I play NBA 2K. And like I've got like the Kobe Froby, like the Afro Kobe like card, and I think I had to spend like, I don't know, close to $2,000 to try to get it. Like, and then you realize that the next season you don't have that card, and it's just a complete
Okay.
waste. Um, so no, I play it for fun for sure. But there are certain categories that I get more sucked into. I agree. For Habby, it's just like a time killer on the metro. But I'm not really invested.
Alrighty. Regarding financing, is there anything that you keep repeating yourself to founders that they just simply don't seem to understand that we could kind of solve for people today?
Yeah. Look, so like I mentioned, in that scenario where you're at a ready state in your product to scale, like you're spending $100,000, you think that if you could double every quarter for like 8 quarters, you're now spending like $2 million a month, right? If you believe that's your trajectory, right, we can one validate that. But if you really are in that trajectory and you need suddenly cash to be able to manifest that outcome, a lot of people do go to VCs, right? They want to give the VCs a slice of their company, and they want like $2 million or $3 million in the bank right now, so that
Just
they
for
can.
marketing.
Yeah, I would argue that like 70% of that is going into marketing. I mean, like they'll say a whole bunch of other things in their deck where they're like, I'm going to hire this person, I'm going to do that. But like in reality, a lot of that is going into marketing, maybe not right away, but the cash flows that are being generated are also going back into marketing, right? So um, you'll easily get to like 70% of what you raised as contribution into sales and marketing. So let's take this example. This is for easy math, right? Let's say your company today was worth $100 million, right? Great company. And this company is like, I want to make this $1 billion company. I need $10 million to invest into marketing and people and whatever. Um, Essentially, you have given 10% of your company to do that, right? $10 million for $100 million valuation, post money valuation. Let's say you actually do achieve what you say, and next year you've grown by 50%. Now your company's worth $150 million, assuming the same like multiples on revenue or EBITDA. Now the 10% that you gave away is worth $15 million, right? Because you're worth $150 million. So over a year, you've now taken $10 million and now you owe $15 million one day, right? So that's a 50% annual interest expense if you spent all of that on marketing. Right?
Wow.
You could have borrowed that from a bank and could have paid up to 49% interest over a year to get that financing, and it would have still been cheaper than the cost of the equity that you just raised.
That's not taking into account the next year when you keep growing, right?
Yeah,
Because it's
exactly.
not. Also, some VCs might not want to sell their thing at what it is valued at. They might be waiting for the long game. So even if you wanted to get that equity back, it's not
I
like you
can
always have
I
the
can
option.
guarantee you that if you are growing at 50% year on year, that VC is going to hold on to that stock until they really can cash out, right? Because
Should we look at a
also,
real example? Oh, sorry.
yeah, so I was saying like VCs are targeting a return like over their 5 or 10 year life cycle of like greater than 30-40% IRR. So like that is what they're targeting. They're not going to be letting go until they reach that, right?
Is it always a 10x type situation with a VC? I've heard that number somewhere. Like,
No, I mean like it's not always that, especially depending on the life cycle of the VC, especially if the VC is like at the tail end of their kind of fund life. Then they're going to be willing to liquidate more so that they can actualize their returns and just show that IRR being actualized so that they can raise a bigger next fund, right? That's how it works.
raise, lend money for marketing to show that I can make money, so I can use that story to market to raise more money to then lend to marketing.
Yeah, yeah, sort of. But that's the crux of it. That I think that people don't realize just by that simple example, right? That if you really are going to grow very quickly, the faster you grow, the more expensive your equity is, right? In that example that I just shared with you, the rate of growth equals the interest rate. So if you're growing at 50% from a $100 million company to a $150 million company over a year, that's equivalent to you paying 50% interest for that $10 million that you raised. And I think like in comparison, like a bank loan, for people who are not familiar in financing, if you had access to a bank loan, that would be like 6% or 10%, right? So like a fraction of that.
But I guess you still have to do the pitch to the bank that they're going to get their money back. Similar to, is it the same? I wonder, is it harder to convince a bank versus a VC in the average model, average example?
100% harder, like almost impossible. At this scale, a bank is, first of all, a bank doesn't know what a cohort is. So they're going to hear you say ROAS and they're going to be like, what? They have like in most banks, I've seen like very progressive banks, like for example, in Israel, they have banks that are able to understand cohorts and they're actually lending out based on cohorts. So I'm sure they'll all get to this and I'm sure they're all smart people that are there. But typically the way that they underwrite is they'll look at your P&L. They'll see, are you burning cash or are you making profits? And then they'll take a look at your cash reserves and they'll be like, how many months of runway do you have until like I'm royally screwed and you can't pay me back? Right? That's typically how they look at it. And they will generally try to find a company that is profitable. But this is counterproductive to a company that's trying to grow very quickly. Because if you think about it, if you knew for a fact you were going to get $2 out for every marketing dollar that you spent today, you should spend every dollar that you have, right? Because like that's the right thing to do for a company. You're maximizing profits. Doesn't mean you're maximizing short-term profits. You're going to be in the negative or very close to the negative if you do that, but you are going to be incredibly profitable in the future if you do that.
That's interesting because two things here. I'm seeing Grammarly ads, I swear, every single day. And I saw they just rose a bunch of money. And I'm thinking of Grammarly when you were talking to me. I was like, how much of the money they raise is just going into marketing? And why didn't they just get a loan?
They did. And they got the loan from General Catalyst, who is our partner and our
No
investor.
equity?
So General Catalyst is quite interesting. They are a huge $30+ billion AUM fund, wildly successful across many categories. So they invested they invest in equity, which includes investing into PVX, my company. They're our investor. But they also have a customer value strategy, which is a portion of their funds and their balance sheet that lends directly into user acquisition financing, the exact same instrument that we're doing. But they focus on very large scale companies like Grammarly. That $1 billion raise was user acquisition financing. So you could estimate that they're spending like $100 million, $80 million to $100 million in marketing. That's why you're seeing their ads everywhere. And all of that is revenue shared. Is I don't know the inner workings of the deal, but that's revenue shared with General Catalyst's customer value strategy, and they're able to scale up pretty much unlimited as long as they're seeing profitable cohorts.
Very interesting. So, wow. Because I'm thinking, this was a conversation I had with you actually. And you mentioned the different ways of people running their business, right? And you mentioned like in the East versus the West, there's different attitudes towards marketing. And then, quick story, I watched a video recently explaining the very high saving rate in China. And like the average household, they save 30 to 40%. And then when you zoom out, they're screwed when you look at it in clear terms because like they have to save money and the main thing they save money for is to buy a house, but they tend to buy a house in like 20 or 30 years. But in America it's kind of the opposite, where they save a lot less but they potentially invest, and then when they invest they get 10% returns, and there's no real equivalent in China. And also in China they've had very recent famines and situations where they've lost most of the money that they have saved. So they tend to buy stuff with like gold or whatnot. And then I thought about like my company. Recently, I put 5K into the company. Otherwise, payroll wouldn't have been met because I did one too many conferences. You probably could see from the LinkedIn post. But as of now, that money's all come back. I've done new deals and I'm happy. And I just spoke to some people who they've run businesses in gaming. They're making over $1 million a year, and the business developer is pretty much only the founder, and he goes to conferences and he spends zero on marketing. And he's so conservative. And I'm just thinking, I'm running my business a lot more like I know in the long term this is going to make money. If I invest in events, which I have been doing for a year, the event loses money on paper now, but all the relationships and whatnot, it's going to be stupid compounding. And if you have a situation where you know in the long term it makes money, then like you said, like I'm going to be kind of more the American way, I guess, like going very close to spending because I know the return is going to be super high, like 5 to 10x versus me just keeping it in an index fund, you know?
Yeah.
So yeah, I just wanted to share that story. It's just I
No,
feel
and I
like I'm
think
money.
it's super relevant, and it actually does play a parallel to the Chinese market, because in China the user acquisition financing or the bank debt is actually, it's much harder to crack because of this cultural mindset, right? Um, and but the Chinese are they're no joke when it comes to business. They know how to sniff money out like very,
Yeah,
very
I
well,
see
right?
on Sensor Tower. I had a little export once. Someone showed me literally top 100. You just see China, 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 10 cent, 10 cent, 10 cent. Like in terms of the apps making the most revenue right now.
Yeah, absolutely. And a lot of them are Singapore, but they're actually Chinese companies incorporating in Singapore as well, like Habi, for example. But the the they will eventually. I'm convinced that user acquisition financing is going to be incredibly mainstream, like as mainstream as VC fundraising, um, especially for companies that get to this level, because it's going to make your life way simpler to basically be able to fund whenever you need the money. Well, be able to spend whenever you need the money, rather than having to raise more and more money. Like fundraising is not a simple task, right? It takes a lot of
Yeah.
time and effort to fundraise. And back to a little bit of a segue back to the banking point. The banks are not going to finance you if you're a tiny company that's spending all of its money on marketing because you have no EBITDA. Your cash runway is dwindling. They're going to look at you as a huge risk.
Why did you walk in
But
the door today?
exactly. But then I don't really care. I mean, you need to have some cash to support your OpEx and your salaries. Like, we don't want you to go under because of that. But like, if you have that minimum amount, but your cohorts look fantastic, I'm willing to fund you to the moon, right? Because I understand how predictable it is. I can see you for what you are, which is a cash or profit printing machine. And
And you're very
I'm,
unique because you're also the
yeah,
end user. Like you said at the start of the podcast, like you know what's possible. And I feel like what you said, like a bank is just not going to have that experience. It's just not going to happen.
yeah, exactly. And I've worked in gaming companies as well, so I know what a good marketing campaign looks like, what it doesn't, and what monetization strategies kind of look like. So that's also all of our team has a mixture of gaming and finance experience. So they're all like ex bankers, private equity, corporate development people, but have focused on gaming. And so everyone in my team is like, why doesn't this exist? Why aren't people looking at cohorts to finance? And to us, it's very obvious. We use it to do M&A. We use it to, to get leverage from, to do equity swaps. We do it for a lot of reasons, but no one is funding and taking risk with that. So I thought that's the reason why we got together as a band and started to do this.
And that explains why everyone's going to VCs because they don't know of an alternative.
Yeah.
I want to take it a bit more personal now. So you mentioned you were in gaming companies and obviously now you're doing this very one of one type of gig. So yeah, what's driving you to do this? Like why you How did you get into this situation? What's driving you to do this every day?
Yeah. So, well, I mean, um, yeah, from a personal standpoint, I think I've always been intrigued at being a founder and starting a company. I used to work at a VC myself, by the way. Um, I was working in a VC mainly for the vantage point of being able to see what industries are interesting to invest my time in. And then, gaming stood out, and so I joined a gaming company, and then I worked with them for 5+ years. That was also an interesting journey. We took that. I mean, we took that. I joined that company very early on. We took that company from, I think, at a Series A of $100 million or something like that to Series E of $2.5 billion company. So I got to see all of the the growth trajectory, but all the cracks in between on the way up, which was incredibly valuable. But I always knew that I wanted to have a crack at it myself. And my co-founder, CEO, and head of analytics, we both essentially came from the same gaming company, Mobile Premier League, and we were like so convinced that the frustration that we had having to raise so much money in order to fund our growth was almost certainly a frustration that a lot of other people are going to have. So I'm, as I said to you before the call, super grateful to be able to hear the founders' stories, but also be able to kind of relate to them in a really meaningful way and be able to say, like, hey, by the way, if you continue to do this, you're going to run into this problem. I think we have a solution. Like, hear me out. I think that's what keeps me motivated in the morning. And then refining that in a way where, honestly, not everything that I propose to them is a great idea, and they give us feedback, and we kind of design the product around hyperscale companies, hyperscale use cases, and I think we're getting better at that every day.
Awesome. Very cool. So the team you've made, from what you said, it's from a team that you've built before. What kind of people do you enjoy working with? I'm just curious for people leading teams here. You've led teams before, now you're doing your own team as well. What kind of people do you work with? What do you test for?
Um, Honestly, I kind of love being the dumbest person in the room. So I think I've been that for nearly the whole of my career. Um, and I've been fortunate to work with people who are patient with me and are willing to kind of show me the ropes. But I find myself in that situation constantly because I'm the type of person who just follows their curiosity, even when I have no business being there. So like I'm a co-founder of a financing company, but I have a marketing background, right? There is some relevance there because we're funding marketing, but when I got into gaming, I was like, you know, uh, I was a VC, right? And before I was a VC, I was doing BD, and so like I always find myself in new environments where I really have to like pick it up from scratch. But people have told me that I'm a reliable executor and like a decent manager. So the people that I like working with are people who are generous with knowledge sharing, who are driven by curiosity as well, similar to me, and have a pretty high pain threshold because uh, sometimes you auto deduct like the learnings and you follow painful paths of mistakes. So the type of people I generally like or that like working with me and I like working with people with high pain thresholds. They don't like get too discouraged by following the wrong path as long as it's not like detrimental. And um, yeah, that's and I've been working with these people, like my co-founder, for 11 years now across 3 different companies, and I think he exemplifies that.
Beautiful. I want to ask if you can share. You're literally investing in games which are doing well. What's scaling right now? What's working? Can you share any secrets from a high vantage point type vibe?
Yeah. Like I think the trend has certainly been hybrid monetizing, kind of like casual titles. Um, which is not to say that the game mechanics of hyper casual are not still monetizable. Like I think a lot of those components, the hyper casual games, are being integrated into like your Forex strategy core games. They're integrated into real money gaming companies. They're integrated into some hybrid casual, but like those game mechanics are still relevant and are still monetizing, but they found a meta which can kind of take the user through a longer journey and a more retentive journey. And I think that's becoming more important. And as I mentioned, that's what we're looking for as well, because we don't want a binary outcome of you acquiring a user and maybe they pay it back or maybe they don't. You want to have multiple chances over the lifetime of that user to be able to monetize them. So I think that becomes extremely important as CACs and CPIs inevitably rise, right? I think also the IAP monetization is becoming more favorable and will become more favorable because of your web shops and your out-of-play store kind of monetization, giving you greater margins than before. And all the more reason why, you know, your core and your hybrid casual games are becoming more and more successful as use cases. In terms of those are just like the categories of and monetization methods, but I'm seeing very clear like scaling winners in Turkey doing puzzle games, like your Merge 2, Merge 3 sorting games. And it's not just like a one-off. It's like, it's a playbook. Like people who have come from Grand Games, not from Grand Games, from Peak and Dream and Good Job Games, that talent pool is now teaching other people and leading other companies into success. And
Do you think it's the
identifying,
UA or the product that they have locked down, or both?
I think for them it's the product. I think for
Oh wow.
them, the differentiating factor is the product. The UA is still at a high level, but not higher than other markets that I've seen. So the other markets that I've seen that are doing well because of the product is Israel. So Israel is also very good at generating, because they come from this like social casino background, and they know how to kind of monetize through this, you know, random mechanism or like luck mechanism. So it influences the social casino aspects of hybrid games, and that plays into puzzle games, that plays into other types of genres, including sweepstakes, real money gaming. They're very good at those game mechanics. On the UA side, though, I would have to say like the Chinese companies are probably dominating. And like a close friend of ours in the firms is the 2.5 Gamers folks. I think they spend quite a lot of time consulting over there. So I haven't met them personally, but the anecdotes that I've heard from them is that they're set up, the teams, the gaming companies are set up in a very fundamentally different way than in the West, where the UA leads or like the chief marketing people over there are actually the most authoritative people in the company, where they can then direct what goes into the game, how the game is balanced, and how the game is monetized, and what mechanics should be. So they'll test a creative strategy, and that strategy just doesn't work, doesn't exist in the game, but if it works on the ad, they're going to introduce it into the game. And the company needs to be built and structured in a certain way to be able to do that very quickly, right? To integrate a winning concept on the UA side very quickly into the game.
Wow. So, like in my world, in business, it's like you build a wait list. Like you build a wait list and then you go build the product. And it's like they've found a way because they're making money. Like the R&D department is like, go check if our players would want this by spending money to attract players, and then go build it later. That's so interesting.
Yeah, and I think that's why they win. And obviously, there's many other factors. A lot of people misunderstand that, like, oh, it's China. They're their talent must be way cheaper than.
What is the biggest misconception about China?
I've yet to find out. That is the China market is the biggest uh, opportunity, I think, in our business that we have not yet cracked. If I mean, I think my running theory about the Chinese companies is that they are uh, very, very relentless about profit, and they really, really don't. Um, I mean, they're very data driven in all aspects of the business, in making the game, in running UA, and in scaling their game as well, making decisions about scaling their game. Which is why when you look at these companies on Sensor Tower, it's like boom,
Mm,
it's like a hockey stick, because they know very clearly what it takes, what the game metrics need to look like before they are super confident that it's going to scale. And once they have those metrics, they're just going to do it. Whereas I think the other markets are, incrementally testing. And maybe that's because they don't have the same conviction in the data as the Chinese companies do.
beautiful. In terms of the founder here, so the founders you're talking to, I like to ask this question. It's very basic, but what is their biggest mistake that they're doing, just in general? Not necessarily about financing, but like the biggest mistake you see a founder doing when you speak to them.
That's a good question. It's a simple but very tough one. I think founders need to be hyper focused on what is going to make their business, a real business. What will it take for them to not live at this scale, but at like a 10x scale? And anything in between, like if you don't get there, whatever you're doing right now doesn't matter. Like it really doesn't matter. You're going to be operating a zombie business essentially. So I think founders are not uncomfortable enough with that state of being, and therefore, and it's usually due to lack of clarity of what is going to bring that business to that next level. But I think it introduces so much complacency if you don't clearly see what's going to take your business to that next level. So for the founders that we're speaking to, what we're trying to do is introduce a more quantitative approach in helping them identify first of all, how do you rank between your peer set, like your category? What percentile are you in terms of some of these key metrics, retention, like peer retention, revenue retention, ROAS, and that gives you like at least a map of where you exist. Because if you aren't at that level, no matter how much you spend in money, like they can outspend you. Like the more profitable companies can outspend you, and you're eventually just going to die because your margins will shrink as they outbid you and outcompete you, and your CPIs increase. So giving them a map of that, helping them validate, if you're not there yet, what needs to happen in order for you to justify like scaling up, I think is going to be really important. And at least that's, I think, the core of the reason why we built our tool, PVX Lambda, is because we think that there's lack of clarity in the market on what it looks like to be a scalable company, to be ready to be a scalable company. And I think this applies to other business sectors as well, like in your business. Like
Literally, I was about to share. Yeah.
yeah, like what maybe you can share, but like do you have a sense of what that looks like, and what is the urgency in getting there? What are you willing to sacrifice to get there?
Yeah. Now you like this. So my goal is personally make so much money so I can make as many babies I want without thinking about how much they're going to cost, and then spend as much time with those babies. And I'm 27. My girlfriend is similar age. So when I zoom out, I'm like, okay, if I have 3, 4 babies, they will cost, let's say, 100K a year or whatever. and not 100k, 100k over their lifetime, whatever. Long story short, I don't have that much time if I want to have this ideal lifestyle. So I have like 2-3 years. So when I started my business, my idea was do the highest return on time money that I can do, which at the start was ghostwriting. So I was ghostwriting everything. I had 8 clients. I was writing everything. My profit margins were really high. And then I realized if I continue doing that, I will make more money in 24 and 2025 than if I hired anyone. I would just objectively just get like 70, 80%. I'm writing words on the internet. And then I was introduced to like a CEO coach, and he exited his marketing agency in the UK. And part of the golden handcuff clause was he had to stay in the business for 2 years as he replaced himself. And he eventually went from 4 days a week to 3 days a week to 2 days a week to 1 day a week. And then he like had a spreadsheet and he mapped out all the processes. And then he realized that's a really useful skill. And now he's consulting others to do the same. And in there, the first exercise we did was, all right, let's get a org chart. I'm like, oh, I don't have one. He's like, okay. And we started mapping it out, the 3 things that a business has, which is getting new customers, so growth, marketing, operations, so delivering anything that you're doing on the marketing side, and then finance, anything outside of delivery and whatnot. And then he put founder should only be doing strategic stuff, maybe hiring other stuff. And then you put your name on every single job title that you're currently doing. And I was on like 15, where it's like, I'm also doing the marketing, I'm editing the podcast. I had like 15 different job titles. And it's like, okay, what's on here not founder worthy? Like, what could be outsourced for less than $20 an hour? And it was pretty much everything on the podcast side, on the research side, all that. I was like, okay. So then I had an EA who was helping me sometimes. I was like, no, I need to make him own the entire podcast, which he now does. I was like, okay, cool. And then you start thinking, okay, how much money do you want to make? So you get a spreadsheet out. It's like, oh, I want 20 or 30 clients. Okay, how many writers would that take? Okay, probably 2 writers. Okay, are you going to manage them? No, ideally I want someone to manage them. And then you start fleshing out this org chart and you realize, okay, for the last 6 months, I'm trying to make more money. But because I spent 0 time on hiring someone or documenting how I do things, this will never happen. Like ever. Like it was just it's not possible unless I did the hard thing, which was hire someone. And then someone did a very nice post on LinkedIn. I can't remember. And he mentioned when you have recurring revenue, you get so complacent. So the work I did 3 to 5 months ago, signing those clients, and I'm doing delivery, and I have decent retention. So it's like the fire was kind of gone. And then I'm thinking about these gaming founders. They have more money than they need, I guess. And potentially they don't know why they're doing it, some people. But with me, I actually know what I want to do. I want to hire my family. So I need to make enough money or add a new business vertical so they can actually make money. So I'm doing the event side as well. And then what ended up happening is I hired. So now the team's 4 full time and now I have payroll. I'm making less money and like my brother's getting more money than me and he's younger than me. But I know by doing that, he will build those skills and so on and so forth. So to kind of bring this to a close, now payroll is a lot higher than it used to be. But now all I need to do is BD. And like I signed 2 clients this week and I know I can sign 2 clients a month to the end of summer and I will like triple the revenue I had a few months ago and also double my take home. But then also I'm funding people now. But I never would have done this if I just didn't have that org chart, which is so crazy to me. Like if I just didn't visualize, like, oh, I can't do this forever, otherwise I'll burn out. Okay, so I need to hire someone. And that was the hardest thing I could ever do. I tried with like 14 writers and I was like, no one can write like me, blah, blah, blah. And what did I actually do? I didn't do a job post. I just messaged a few people I knew. And then I actually just doubled down, stuck with someone for a few months. And then, we made it work. And it's very hard. I'm more stressed than I was 5 months ago, but it's a lot more exciting because I just saw it for what it is. Like I have no choice. I have to make that hard choice. And yeah, now we're getting there.
It's all about leverage, isn't it? It's one is you're hiring and you're building an organization that you can leverage even in your absence, right? So all you need to input into it is capital and direction. And ideally it can function as something that is going to amplify the value. And if you do that, really, all the successful founders do that incredibly effectively. Like if you like, I still get like, shocked or like emotional by seeing Bill Gates sitting next to Satya Nadella they're sitting on a couch, and sorry, there's Steve Ballmer there as well, and they're sitting on a couch, and it's like, dude, that guy built this entire industry, and now there are two other billionaires who are sitting next to him, who are running the show, right? And like tens of thousands, hundreds of thousands of people working underneath, and everyone having their software on their laptop, like, and he all he did was make himself obsolete and steer the company in a direction. Um, so yeah, that's what a founder does or should do.
Yeah, but like my favorite quote, you don't know what you don't know. If I just didn't have that chat with him and just seen him do it, I was like, oh yeah, this makes sense. Cool. Like if I just never had that call, like I wouldn't have been doing 3 podcasts this week because I would have no time to prep them, because I wouldn't have helped that person. I'm
Absolutely.
really enjoyed this conversation. I've got 2 more things. Anything from the podcast that we did today that we feel like we haven't spent enough time on that you want to cover? Anything for anyone listening to this who's got a game?
No, I think just to reiterate, the main point was actually no. I think we've spent enough time on that. Anything else that we haven't covered? Probably.
Or maybe is there a message you want to leave everyone listening here?
Actually, maybe I can tell you about the story of why we named ourselves PVX. So PVX stands for player versus X, as opposed to player versus player, player versus environment, player versus monster, etc. Me and my co-founders were thinking about what we should name this company. It's going to be a financing company, so it can't be too like ridiculous. But player versus X felt like it reflected how hard the journey is in being a successful founder in gaming, because you're basically just against everyone else. Like, it's so competitive. Someone could easily replicate your IP. The marketing kind of platforms are like trying to shank you and take more money from you. Apple and Google are trying to take more margins from you. It's just very, very tough. It's rewarding, but it's also very tough. So that founder journey felt like player versus X, and we wanted to be partners for founders who felt this way, because it's a lonely and grueling journey. Why shouldn't you have a partner that is willing to kind of take risk with you and also want you to scale to your maximum profitable potential? That's the story of the name of the company.
Very cool name. I like it. So, yeah. Any hot takes do you have? You told me to ask you that. I wanted to. Is there a hot take you have in life?
A hot take? Yeah, actually, I was having a dinner the other night, and I was asked this, so I don't know how it just came out of my mouth, but I said, I think that aspirational role models are overrated, and that bad role models are underrated. I think you can, in the sense that they're more useful to you in your life. So, which is to say that if you were to take cues from anyone in the world, I think you should be taking cues from an archetype that exemplifies behaviors that you want to avoid, rather than behaviors that you want to emulate. And this is because, for me, maybe it's because I'm trying to optimize for regret minimization. Essentially, that's my framework. But I think it's, people who are dishonest, people who are willing to give up like everything in their life for money, people who take credit from other people. Like, these are all things that you can easily remember to avoid, rather than someone who's like, oh, this person is like kind, or this person is like, very smart or intelligent. Like, it's much easier to remember the path that I shouldn't walk, rather than try to emulate a path that I should walk, because you never know 99% of the things that aspirational archetype is giving up in order to achieve that. So I think the hot take, if I had one, was that bad archetypes or bad role models are more useful than you think.
Yeah, I would agree. And I think it's especially useful if the role model maybe like on the surface is very good, and most people would aspire to be that, but then they have these traits that you don't like. But so it's like in my head, I'm like, just remove those. And obviously, some argument like you need the dark for the good sometimes, but I think that part is potentially overrated as well.
Yeah, true.
Amazing. Ridzki, thank you so much. Where can people get in touch if they want to ask you questions about anything we discussed today? Best place to reach you?
LinkedIn. Add me on LinkedIn. I'm pretty responsive over there. And if you're interested in any of the tools that we create, just visit pvxpartners.com and then sign up for either the financing or the SaaS tool.
Nice. And the SaaS tool is, how much does it cost?
It's free.
Wait. So yeah, definitely everyone should check that out. Sweet. Thanks so much. And if you enjoyed this podcast, send it to a friend. Thank you.
Cheers.